Keep an eye on
Right
the volume.
now, as you watch this video, the dollar is surging.
Pushing.
The DXY index just recorded its best week in years. Analysts are celebrating. The markets have breathed a sigh of relief. And the world continues to believe that the US dollar is the ultimate safe haven on the planet. Here's the problem. This surge happened right in the middle of a war. On February 28, 2026, the United States and Israel launched joint strikes on Iranian military facilities. Operation Epic Fury. Missiles, smoke, full-scale geopolitical escalation in the Middle East. Brent crude oil spiked 13% in a matter of days, reaching $82 a barrel. Commodity markets went into high alert, and the dollar jumped 2.4% for the week. The best weekly performance since 2022. This should worry you much more than any crash, because what this video is about to show isn't what most analysts are telling you. The dollar isn't strong. The dollar is trapped, and the very mechanism holding it up right now is exactly what will destroy it when it stops working. Let's talk about $3.2 trillion wiped out in 24 hours. About the largest two-day collapse in the history of financial markets. About a system that had already cracked before the first missile of Operation Epic Fury was even launched. About $82 oil and what the path to $100 a barrel does to the invisible architecture sustaining the global dominance of the dollar. And about the one scenario where defenseless stops being a metaphor and becomes a reality. But it all starts with a paradox that needs to be solved. Why did the event that should have destroyed the dollar actually make it stronger? And why is this seemingly good news actually the most dangerous signal out there? Conventional logic goes like this. War in the Middle East means geopolitical chaos. Chaos means a flight from risk assets. Oil surges, uncertainty spikes, markets tumble, and the dollar falls right along with them. It's the standard playbook. It's what has happened during other historical moments of escalation in the region. But that's not what happened after Operation Epic Fury. Oil skyrocketed, yes. Tensions escalated, absolutely. But global capital did the exact opposite of what the conventional script predicted. Instead of fleeing the dollar, it rushed toward it. 5 weeks of gains for the DXY, the best week since 2022. Right in the middle of a war, the dollar was gaining strength. That's called safe haven demand. And it looks like strength. But it's not strength, it's dependency. And dependency is the most fragile thing in a financial system. What this safe haven reveals is something far more disturbing than a rally in the DXY index. The world still hasn't found anything better than the dollar to run to when fear hits. Not because the dollar's structurally sound, but because it's still everyone's last resort. And when a system's last resort has deep structural flaws, that system has no way to defend itself once those flaws become visible enough to break the reflex. That is the question that will run through every section of this video. What happens when the safe haven stops rallying? When the next major crisis doesn't trigger a rush to the dollar? Hold on to that question. The answer lies in what the system has already revealed about itself over the past 12 months. To understand why this question is so critical, we need to go back to the beginning, to the moment the first crack appeared. Because it was in April 2025 that the system gave its first clear signal that something had changed, and the sheer scale of what happened then has no precedent in the modern history of financial markets. On April 2nd, 2025, Donald Trump took the podium and announced what he called Liberation Day, sweeping tariffs, wiping across the global map, a declaration of economic warfare against almost all of the United States trading partners simultaneously. China, the European Union, Japan, Canada, a list that included nearly every economy the US had significant trade relations with. The market took just a few minutes to process what happened, and then it collapsed in a way with no documented precedent. Dow Jones down 4,000 points in a single day, a 9.48% plunge. S&P 500, down 10%. NASDAQ, down 11%. In 24 hours, $3.2 trillion in market value was wiped out. Adding the next 2 days, the figure reached $6.6 trillion. The largest two-day wealth destruction in the recorded history of global financial markets. Bigger than anything that happened in 2008. Bigger than the crash of 1987. Bigger than the early days of the pandemic in 2020. Think about what that number means in concrete terms. $6.6 trillion is more than the GDP of Japan, the third largest economy in the world. It's almost 3 times the entire GDP of Brazil. It was obliterated in 48 hours by a trade policy announcement. Not by a war. Not by a banking collapse. By a tariff announcement. And where was the dollar during all this? The dollar survived the initial shock, but what Liberation Day did wasn't just destroy value in the stock markets. It did something much more lasting and much harder to repair. It destroyed credibility. Credibility in American institutional stability. Credibility in the predictability of U.S. economic policy. Credibility in the idea that the U.S. is a reliable arbiter of the global economic order, an arbiter that sets the rules and sticks to them, that doesn't change the rules of the game with a single presidential announcement. That credibility doesn't come back with a trade agreement signed in 60 days. It doesn't come back with a diplomatic footnote. Once the world sees that a single announcement can wipe out $6.6 trillion in 48 hours, the perception of systemic risk changes, and it doesn't completely change back. Because the risk that markets learned to price in back in April 2025 isn't the risk of specific tariffs existing. It's the risk that any global trade structure based on American agreements can be reversed in real time by a unilateral decision. That is a different kind of risk, and it's a risk that has no natural hedge. It was the first crack, and in the following months, the system showed that it had bent in a way that it couldn't fully straighten back out. Because in January 2026, the dollar hit its lowest level in 4 years. And that wasn't an accident. You have to understand the difference between a crash and a decay, because confusing the two is why most people don't understand what's happening to the dollar. A crash is acute. It has a clear breaking point, a visibly panicking market. A drop you can point to on the chart and say, it was right here. And crashes have a recovery mechanic that markets know very well. You buy the dip. Wait for the panic to pass. Wait for liquidity to return. Wait for institutions to rebuild their positions. Markets have ready-made reflexes for crashes. A decay is different in every dimension. It has no obvious breaking point. It doesn't trigger the same alarms. It is the gradual, continuous erosion of the conditions that made an asset reliable, of the premises that made a currency the preferred destination for global capital. And the problem with decay is that it flies under the radar until it has advanced too far to be reversed by marginal adjustments. The 4-year low in January 2026 was decay. It wasn't an external shock. It was the foreign exchange market, which is the most honest market in the world regarding long-term fundamentals, silently pricing in what stock indices weren't yet willing to admit. The causes were structural. Trade policy uncertainty. Markets couldn't project with any confidence what American tariff policy would be 6 months or 12 months from now. Any projection of trade flows had a variable of political uncertainty that didn't exist prior to Liberation Day. Fiscal deficit trajectory. The United States was adding public debt at a speed unprecedented outside of declared wartime, with the rollover cost of that debt growing alongside the very interest rates the Fed needed to keep high to contain residual inflation. Trade friction. The tariffs hadn't been reversed. They were reconfiguring global supply chains, redirecting trade flows, and creating incentives for more international transactions to be settled outside of dollar-denominated systems. Growth deceleration, an economy losing momentum while carrying the growing weight of debt and high capital costs, is a combination that historically puts pressure on any currency. None of these causes was an event. They were all processes. Ongoing processes, worsening, with no natural reversal mechanism in sight. The January 2026 low wasn't a scare that the market processed and forgot. It was the Forex market saying, in the language of prices, that something had structurally changed, that the decay had reached a level where it needed to be acknowledged. And then February arrived, and it brought two separate shocks in a single month, each with a scale of value destruction that in any other recent historical period would have been the event of the year. The first was from February 2nd to the 6th, 2026. The American tech market went into a 48-hour collapse that wiped out $3.6 trillion in market value. The trigger wasn't an external event. It was the internal concentration of the system itself. The U.S. stock market had become dangerously dependent on a very small number of large-cap AI and tech companies. When the growth narrative of these companies began to be questioned by revenue data and revised projections, there was no shock absorber. The risk was too concentrated for orderly exits to exist. When everyone is positioned on the same side of a very concentrated trade, there's no smooth exit. There is collapse. $3.6 trillion in 48 hours. The second multi-trillion-dollar event in less than a year. And here is the data point the pattern reveals, which is more important than any isolated shock. A $6.6 trillion event is an extreme historical moment. Two events over $3 trillion in less than 10 months is a pattern. And patterns communicate something about the underlying structure of the system, not about the specific triggers that set them off. The pattern says, the American system is operating with elevated structural fragility. It is subject to trillion-dollar scale collapses with a frequency that has no modern historical precedent. And the triggers keep being different tariffs, tech concentration, which means the problem isn't any of those triggers. The problem is the level of systemic instability that allows any trigger to produce trillion-dollar scale destruction. And then, on February 28, 2026, came the second shock of the month. Operation Epic Fury. Joint strikes by the United States and Israel on Iranian military facilities. The most significant escalation in the Middle East in years. Brent crude spiked 13% immediately, hitting $82 a barrel. Commodity markets processed the implications in real time. The Strait of Hormuz, which sees roughly 20% of all globally traded oil pass through it, was well within the disruption radius of this conflict. Any further escalation, any Iranian response threatening the strait, would put the path to $100 a barrel not as a hypothetical, but as a baseline forecast. Two shocks. 1 month. A tech crash and military escalation. A system that was coming off a 4-year low in January, and a historic collapse in April 2025. And it's in this context, this specific context, of accumulating fragility, that the dollar had its best week in years. Then comes the question that changes everything. Why? What does it mean for an asset to surge exactly when the system holding it up is weaker than ever? The mechanics of a safe haven work like this. When global fear spikes, when a war breaks out, when a major market collapses, when geopolitical uncertainty reaches a level that paralyzes investment decisions, capital from all over the world seeks the most liquid, most stable, and most universally accepted asset in existence. For decades, that asset has been the US dollar, specifically materialized in US Treasury bonds. Not because the dollar is perfect, not because the United States is a model of responsible fiscal management, but because, in a moment of crisis, everyone wants the same asset, And the fact that everyone wants the same asset is what guarantees you'll be able to sell it when you want out. It's a self-fulfilling prophecy. The dollar is the safe haven because everyone flees to it. Everyone flees to it because it is the safe haven. When Operation Epic Fury launched and oil skyrocketed, what happened next was the most predictable thing imaginable. Asian sovereign wealth funds, European hedge funds, central banks around the world, they all did what they've always done in a crisis. They bought dollars. The DXY jumped 2.4% in a single week. Its best performance since 2022. But this isn't a demonstration of strength. It's a demonstration of dependency. And dependency isn't the same as strength. Here's the distinction that changes everything. A strong currency is one whose fundamentals justify the demand. A currency where dependency is structural, where the world buys it not because they love its fundamentals, but because they've got no ready alternative. That currency's vulnerable in a very specific way. Dependency works right up until the moment the dependents begin, individually and collectively, to seek out and build alternatives. And when the alternative arrives, when the weight of the alternative is large enough that the knee-jerk rush to the dollar weakens, the fall isn't gradual. It's abrupt, because the mechanism that was masking the structural problems suddenly stops masking them. The DXY surge in February 2026 is the clearest possible picture of just how deep this dependency still runs. And it's exactly this depth that makes the rupture scenario so dangerous. Because the greater and more deeply rooted the dependency, the more violent and abrupt the break is when it happens. The sign of health that markets are reading as strength is, in fact, the sign that the system is still running on inertia. And inertia is not solid footing. Inertia is the residual movement of something that no longer has what was propelling it. And oil at $82 is where the movement starts becoming visible in the real economy. Tangible, every day. The transmission channel from the Middle East conflict to the global monetary system isn't abstract. It operates through energy prices. More expensive oil means more expensive energy across the entire production chain. Transportation, manufacturing, logistics, food, heating. More expensive energy means persistent inflation in virtually every sector. And persistent inflation puts the Federal Reserve in front of a dilemma that has no clean resolution. If the Fed raises interest rates to fight inflation, it strangles economic growth, which was already slowing down. It also drives up the cost of rolling over the U.S. public debt, which was already a massively scaled problem. And it disincentivizes investment in an economy that desperately needs investment to grow. If the Fed doesn't raise rates and lets inflation persist, the dollar's purchasing power continuously erodes. People holding dollars are left with less buying power with every passing month. Either way, the dollar loses. The only difference is how fast. But there's a second effect of persistently high oil that is slower, deeper, and that short-term headlines rarely catch. The effect on the petrodollar. Since the 1970s, following the collapse of the Bretton Woods gold standard, the global dominance of the dollar has been rebuilt on a pillar that doesn't appear in treaties, but is more powerful than any of them. Global oil is priced in dollars. This means that any country in the world that needs to buy oil, and almost all of them do, must first have dollars. To get dollars, they have to sell their goods and services in dollars or buy dollars on the foreign exchange market. This creates a structural, permanent, global demand for the dollar that doesn't rely on trust in American economic management. It relies on energy physics. That's the petrodollar system. And it's what turned the dollar from the currency of the world's largest economy into the oxygen of the global economy. When oil rises to $82 and heads toward $100, two processes accelerate in parallel. First, The cost of maintaining sufficient dollar reserves to cover energy imports increases for all oil-importing countries. This puts pressure on the national treasuries of emerging and developing economies that are already under fiscal strain. Second, the incentives to find alternatives to the petrodollar system to build bilateral and multilateral energy trade mechanisms that bypass the dollar increase proportionally. It's no coincidence that BRICS nations have accelerated talks about bilateral trade instruments in non-dollar currencies over the past 2 years. It's no coincidence that bilateral agreements between China and Persian Gulf oil-producing countries are being built with financial infrastructure operating outside the SWIFT system and dollar rails. It's no coincidence that central banks around the world, from China to India, from Brazil to Gulf nations, have been adding gold to their reserves at a pace unprecedented in recent decades. These movements are gradual. They are slow. They don't generate headlines like "the petrodollar died today." But each one is a brick being removed from the foundation, and persistently high oil, especially high oil fueled by geopolitical instability that the United States cannot resolve, as is happening now in the Middle East, accelerates the pace at which these bricks are removed. $82 a barrel isn't just a fuel price problem. It's a slow solvent that erodes the architecture maintaining the global structural demand for the dollar. And the path to $100, which the conflict with Iran has turned into a real operational scenario rather than a hypothetical one, accelerates this process in a non-linear way. Each price hike doesn't just sustain the existing pressure. It creates new incentives for more actors to seek more alternatives with greater urgency. But if oil is the threat that starts on the outside and seeps in, the American fiscal deficit is the threat born on the inside, growing without any visible containment mechanism. The United States is piling on public debt at a pace that, outside of declared war mobilization periods, has no modern historical parallel. The annual cost of paying interest on the existing debt, not the principal, just the interest already exceeds the federal defense budget in some projected scenarios. And that number grows automatically as the debt grows, and as interest rates remain at elevated levels. This is what economists call crowding out. Interest payments don't just cost money in the budget. They compete directly with everything else a country needs to fund to maintain long-term growth: infrastructure, research and development, education, industrial capacity, and public health. The larger the slice of the budget going toward debt interest, the smaller the government's capacity to invest in the things that generate future growth. Less growth means a smaller tax base. A smaller tax base plus rising interest expenses equals larger deficits. Larger deficits mean issuing more debt. More debt pressures the dollar and raises borrowing costs. Higher costs slow growth even further. The cycle closes and tightens. Now add the trade friction of tariffs to this cycle. The Liberation Day tariffs weren't just a short-term market shock, they reconfigured global supply chains. Companies with decades of productive organization based on free trade and global integration suddenly faced incentives or pressures to move manufacturing, reorganize sourcing, and diversify trading partners outside the sphere of American predictability. This reconfiguration process is slow, it's expensive, and it's inflationary. There is no scenario where major supply chain realignments happen without cost, and those costs are expressed as higher prices for the consumer, which is another way of saying the erosion of the dollar's purchasing power. And trade friction has a second effect on the dollar that goes beyond inflation. It weakens the argument for the dollar as the global reserve currency. The demand for dollars as a reserve is partly tied to the fact that the United States is the central trading partner of the global system. When the U.S. becomes an unpredictable trading partner, when any trade structure with the U.S. can be rewritten by presidential decree, the incentive to hold heavy dollar reserves diminishes. Now add slowing growth. An economy that grows less generates less tax revenue. Less revenue with higher interest expenses produces larger deficits. Larger deficits require issuing more debt. More debt pressures the dollar. Pressure on the dollar raises borrowing costs for the entire private sector, not just the government. Higher private borrowing costs slow down investment and, therefore, growth. These three vectors, a growing deficit, active trade friction, and slowing growth, don't just add up. They multiply. Each one amplifies the effects of the other two. And this multiplication is what makes the current situation structurally different from every dollar crisis that came before. In previous crises, the Nixon shock, the 1987 crash, 2008, the pandemic, one or two of these forces were active, and there was always room to maneuver. Monetary policy could compensate for fiscal problems. Growth could offset the deficit. The safe haven, that automatic flight to the dollar in a crisis, could offset momentary distrust. Today, all three are active at once. Growing deficits, trade friction, slowing growth not in sequence, but simultaneously amplifying each other. And each one's removing a safeguard that historically let the dollar survive its own crises. What this builds is the exact structural condition the title of this video describes. Not a collapse, something more specific and more dangerous. Defenseless is a precise word, and it doesn't mean what you might think. It's not saying the dollar collapses tomorrow. It's not predicting hyperinflation next week. It's not a doomsday forecast. It's describing a specific state of the system that's approaching. Historically, the dollar always had a fallback, a last line of defense that compensated for its structural problems, the safe haven. When everything else fell, the dollar rose. When fear hit global markets, capital fled to the dollar, and that flight offset any fundamental pressure pushing it down. The safe haven was the system's insurance for decades. The defenseless moment is when this insurance fails. Not when the dollar falls. It falls all the time and always bounces back. It's when the dollar falls and doesn't bounce back. It's when a crisis hits. War, financial collapse, systemic shock, and the DXY doesn't register its usual emergency rally. It's when markets realize, collectively and irreversibly, that the flight to the dollar isn't the automatic reflex it used to be. And the conditions for this moment are being assembled right now, in real time, by the exact forces we've described. The fiscal deficit removes the argument that the dollar represents a fiscally responsible and predictable economy. Trade friction removes the argument that the dollar represents an open and reliable trading system, with stable and guaranteed rules. High oil prices and the de-dollarization alternatives they stimulate remove the argument that the dollar is necessary and inevitable to participate in the global energy economy. The accumulation of trillion-dollar scale shocks at intervals of less than 10 months removes the argument that American markets are the most stable and predictable in the world. Each of these arguments is a pillar of the safe haven status, and every pillar eroding at the same time raises the probability that, in the next major crisis, the flight to safety reflex toward the dollar will be weaker than the last one. And if it's weak enough, if the DXY falls during the next major crisis instead of rising, the safe haven narrative breaks. And when that narrative breaks, it isn't easily rebuilt. Because what will be broken isn't the narrative, it's the mechanism itself. That's what defenseless means. Not that the dollar's worthless. It means there's no floor, no mechanism that's always cushioned the falls and bought time for structural problems to be ignored one more cycle. With a floor, the dollar can have structural problems and remain the dominant currency indefinitely. Because every crisis, paradoxically, strengthens it. Without the floor, structural problems are exposed without a buffer. And structural problems exposed without a buffer adjust in ways that markets rarely manage to anticipate accurately. Right now, as you watch this, the DXY is hovering around 98 to 99. The Middle East is escalating, oil's at $82, and the path to $100 is a real operational scenario. American deficits keep growing, supply chains are reconfiguring, and the world keeps rushing to the dollar when fear spikes, because there's still no ready alternative liquid enough to replace it as a safe haven. But the window where the safe haven works automatically is being narrowed by forces that can't be reversed by a single policy, trade agreement, or presidential speech. These are slow-building forces that have already gone too far to turn off. The paradox we started with, the dollar rising in the middle of a war, has a resolution that's both obvious and disturbing. The dollar goes up because the world still depends on it, because there's nowhere else to run. This dependency is real and it's deep, and that's exactly what'll make the rupture, when it hits, more severe than any the system's ever experienced. The defenseless moment isn't when the dollar falls. It's when the dollar falls and the world doesn't rush after it. Once you get this, the 2.4% rally in February 2026 stops looking like good news. It looks like what it really is, the final image of a reflex that's still working. For now. If this analysis changed how you're looking at what's happening in the markets right now, drop a like. It helps the channel keep bringing you this kind of insight before it becomes consensus. Subscribe to catch the next video, and let me know what you think in the comments. Will the safe haven reflex still work in the next major crisis? Or have the conditions we're describing already gone too far for that?